You're not broke because you spend too much, and you're not going to run out of money in retirement because you didn't save enough. The uncomfortable truth? The system was never, ever designed for you to win. It was designed to keep you comfortable, right up until the trap springs. I want you to really picture this for a second. For 40 years, you did everything right. You woke up early, you fought through the grinding traffic, you worked incredibly hard, you saved consistently, and you followed the exact playbook they handed you. You put your money into a target date fund, you slowly decreased your risk as you got older, and you planned to withdraw that magical safe 4%. But what if those rules were designed for an economy that literally no longer exists? What if the very advice meant to protect you is the exact mechanism that's going to bleed you dry? Welcome to USA Rift. Today, we're tearing down the illusion of safe retirement in this deep dive explainer. We are exposing the hidden, systemic wealth killers that structurally drain your accounts before they ever even have a chance to survive. We're going to show you exactly how money really works at the end of your career and who is actually profiting off your safety. Before we pull back the curtain on this, make sure you subscribe to the channel, like the video, and leave a comment down below on what you thought. And please, if you want to support this kind of research, support the channel by becoming a channel member. All right, let's examine the reality.
For decades, the mainstream financial industry has fed us a very specific, very polished narrative, a narrative that comfort equals security. We're told, over and over again, to slowly move our money into bonds as we get older. We're told to play it safe, to avoid volatility at absolutely all costs. But I want you to ask yourself a serious question right now. What if the safe path is actually the riskiest path of all? The entire architecture of modern retirement planning, the very system relied upon by millions of hardworking Americans, contains a massive, undeniable structural flaw. It's a complete blind spot. The financial industry sells you the idea of a smooth ride, but by trying to completely avoid short-term market dips, millions of people are unwittingly guaranteeing their own long-term financial ruin. Think about that. They are trading the temporary, emotional discomfort of market volatility for the permanent, irreversible devastation of running out of money entirely.
So, let's break this down. Section 1. The average return illusion. Average returns versus sequence of returns.
To understand how this trap actually works in the real world, we first have to completely shatter the biggest lie in modern finance. When you sit down with a typical financial advisor, they love to show you this beautiful, comforting chart. They'll tell you the market averages 7 or 8% a year over the long haul. They run a neat little simulation, they draw a smooth, predictable line heading steadily up and to the right, and they look you in the eye and tell you that your future is totally secure. But here's the problem. You do not live in an average, you live in a sequence. Averages completely hide the violent, unpredictable reality of the financial markets. Average returns assume your money is just sitting untouched in a vault somewhere, compounding smoothly in a vacuum. But the reality of retirement? You're actively pulling money out of that vault just to survive. Imagine two neighbors, both retire on the exact same day with the exact same amount of money in the bank. Over a 25-year period, they both experience the exact same average market return. Yet neighbor A dies a multimillionaire and neighbor B goes completely bankrupt in year 15. How is that mathematically possible? It all comes down to the order of the returns. If the market crashes in the first 3 years of your retirement, you don't get to just pause your life. Neighbor B still has to pay for groceries. They still have to pay soaring property taxes. They still have to pay the electric bill. And to pay those bills, they are forced to sell their shares while the market is down 30%. Those shares, they're gone forever. They can never ever participate in the eventual market recovery.
This is what the industry calls the silent wealth killer, sequence of returns risk, or SOR. By definition, it's the uncompromising danger that poor market returns in the early years of retirement permanently destroy your capital, simply because your withdrawals lock in your losses. I want you to think of your portfolio as a massive, powerful machine that generates a certain amount of electricity. If you're forced to dismantle pieces of that machine, ripping off gears and selling them as scrap metal just to keep the lights on during an early recession, well, the machine eventually becomes too small to ever power your life again. The mathematics of sequence risk are brutal, and they are entirely unforgiving. It absolutely does not matter if the market goes on a massive, record-breaking 10-year bull run right after that initial crash. It's too late. The base of your wealth has been structurally eroded. You are locked in a mathematical death spiral. And the absolute worst part? The true tragedy here? Most people don't even realize they're financially ruined until a full decade after the damage is already done. Their monthly statements still show a balance, but the underlying engine? The engine is already dead.
Let's move to the next threat. Section 2. The healthcare time bomb, the healthcare inflation reality.
As if the unforgiving math of the stock market wasn't dangerous enough on its own, there's a secondary, external force accelerating the drain on your wealth, a force entirely outside of your control. Even if you manage your investments flawlessly, if you don't account for the structural explosion in medical costs, your retirement is going to turn into financial fragility practically overnight. Consider this staggering fidelity estimate for 2025, $172,500. That's what a single 65-year-old retiring today can expect to spend in out-of-pocket healthcare costs throughout their retirement. That is a massive 4% increase from just last year alone. But here's the most terrifying part about this number. It's a complete illusion of safety. It's a smokescreen. That number only covers standard Medicare premiums, basic co-payments, and prescription drugs. Do you know what it completely excludes? It completely excludes long-term care. It excludes nursing homes. It excludes assisted living. Standard Medicare does not cover the custodial care you might need to simply get out of bed, or bathe, or eat. Those facilities currently cost upwards $100,000 for a single year. Actuarial data actually projects that a healthy 65-year-old retiring right now could easily spend closer to $300,000 on healthcare over the course of their retirement.
This healthcare inflation reality is a compounding nightmare. Look, we all feel the pain of general inflation, right? The rising cost of groceries, the pain of the gas pump, but medical costs are rising substantially faster than general inflation. Specialty drugs and advanced life-saving therapies are skyrocketing in price every single quarter. And as government policies continually shift, high-income retirees are increasingly exposed to higher premiums and devastating income-related surcharges. This isn't just a line-item expense on a spreadsheet. It is a predictable, compounding wealth extraction. If you're relying on a conservative, slow-growth portfolio that is heavily weighted in bonds, like the experts tell you to do, you are mathematically guaranteeing that healthcare inflation will permanently outpace your returns. Costs that feel slightly annoying but manageable today will easily triple or quadruple by the time you reach your mid-80s. The system is designed so that you will be systematically priced out of your own survival.
Which brings us to the solution. Section 3. The counterintuitive equity secret. The structural trap and the new glide path.
So, let's recap. The system has essentially set you up. The market threatens to wipe you out early with sequence risk, and healthcare inflation threatens to bleed you dry late. So how does the mainstream financial industry tell you to protect yourself from this? They sell you a product that systematically locks in your failure. Target date funds have become the absolute default for millions of Americans, currently holding over $3.75 trillion in assets, trillion with a T. Their underlying logic seems incredibly sound on the surface. As you get older, the fund automatically sells your stocks and buys bonds. They call it a declining glide path, or you might know it as the old age in bonds rule. But we need to deeply examine the actual mechanical reality of this trap. Imagine the market drops 20% in your first few years of retirement. A target date fund does not patiently wait for a recovery. The algorithm triggers. It doesn't care about your dreams, it doesn't care about your fears, and it certainly doesn't care about your grocery bill. It systematically, blindly sells your best assets, your Apple stock, your Microsoft, your broad index funds, while they are down at their absolute cheapest valuations, just to buy more low-yield bonds. It automates your permanent loss. It literally kills the only growth engine you desperately need to survive a 30-year retirement and outpace that crushing healthcare inflation.
But the data clearly shows we must do the exact opposite of what the industry preaches. Welcome to the Rising Equity Glide Path. This framework, developed through extensive, rigorous academic research, is how you actually survive the modern economy. Instead of holding 80% in stocks on the day you retire and crossing your fingers, you start out highly conservative, maybe 20 to 40% in equity, with the rest parked safely in cash buffers and short-term bonds. Now, why would you do that? To completely and psychologically neutralize sequence of returns risk. If the market crashes in year one, your cash buffer absorbs the blow. You don't have to sell a single share of stock. This protects you mathematically, sure, but more importantly, it protects you mentally. It stops the panic selling. You can actually sleep at night while the market burns outside. Then, as you move safely through retirement, you slowly and systematically increase your equity exposure. You actually buy more stocks as you age.
Landmark research by financial experts Kitzes and Pfau proves a stunning reality. Rising equity glide paths create a heads-you-win, tails-you-don't-lose outcome. Here is the absolute structural brilliance of this counterintuitive strategy. If the stock market performs horribly in the first decade of your retirement, you're protected by your cash. You're completely insulated. But because your plan requires you to slowly increase your stock allocation, you're systematically dollar-cost averaging into the market at cheaper and cheaper valuations. You are automatically buying the dip without even trying. And what if the market performs incredibly well in your first decade? Well, you make so much money off your initial 20 to 40% allocation that the rest of your retirement is entirely secure regardless of what you do. It forms an impenetrable mathematical fortress around your wealth.
But listen closely. If you're going to systematically buy into equities as you age, you need to deeply understand where the actual value is hiding.
Right now, the system has everyone blindly crowded into a handful of massive tech companies. The S&P 500 is incredibly top-heavy, but the actual data reveals a completely different story beneath the surface. U.S. small-cap stocks are currently in their cheapest valuation quintile relative to large caps since 1990. In simple terms, if you divide the historical data into 5 equal parts, or quintiles, small caps right now are sitting in the absolute bottom 20% of their historical pricing. They are effectively on a generational clearance sale. Since the Great Depression, the performance cycle between large and small stocks has predictably averaged about 7 years. The current large cap dominance we're living through right now is a massive historical outlier. Small caps right now are mathematically priced for a structural rotation. They are the suppressed growth engine just waiting to be ignited.
And the historical odds here? They're absolutely staggering. When U.S. small caps reach this cheapest quintile, the exact rock bottom level they're at right now, history shows us exactly what happens next. Over a 10-year period, they have historically outperformed large caps 96% of the time. 96%. With shifting corporate dynamics benefiting domestic manufacturing and the potential lowering of interest rates providing massive relief to small companies holding floating rate debt, the structural setup is undeniable. But you must pay attention to the warning signs. You can't just blindly jump in. 41% of the Russell 2000 small cap index components currently generate zero earnings. Zero. They are zombie companies surviving entirely on fumes. You cannot just blindly buy the index and hope for the best. Active management and ruthless, strategic stock selection are absolutely required to exploit this pricing inefficiency without stepping on a massive financial landmine.
Let's bring it all together. Section 4, the new safe withdrawal math, supercharging to 4% rule. So, we've dismantled the target date fund trap. We've established the undeniable necessity of a rising equity glide path and the profound valuation advantage hiding in small caps. Now, we arrive at the final, most critical piece of the entire puzzle. How much money can you actually take out of the machine to live your life without breaking it? We have to rethink the most famous rule in finance. Back in 1994, financial planner William Bengen created the legendary 4% rule. It became the unquestioned gospel of retirement planning. But Bengen has returned with massive new research in 2025 and a structural update that changes everything. The new universal SafeMax withdrawal rate is now 4.7%. On a $1 million portfolio, that's the difference between taking out $40,000 and $47,000 in year one. That is not just numbers on a spreadsheet, folks. That's a 17.5% increase in your actual lifestyle. That's an extra vacation. That's covering your soaring property taxes without feeling an ounce of stress. Bengen ran 400 historical retirement scenarios, and only the absolute worst-case economic disaster in a century of data required a rate as low as 4.7%. For the flexible retiree, that number can often push much, much higher.
But here is the catch. The system doesn't just hand you that 4.7% on a silver platter. You don't get it by being lazy. You don't get it by holding a basic, outdated mix of S&P 500 stocks and government bonds. Bengen's new math requires you to completely supercharge the rule. Step 1, you must diversify far beyond basic large caps. Step 2, you must intentionally include small caps, mid caps, international assets, and substantial cash buffers. And step 3, this is the absolute most crucial element. You must abandon the set-it-and-forget-it mindset entirely. You have to review and adapt your withdrawal rate dynamically every single year. What does that actually look like in reality? Well, if your portfolio is growing and the markets are strong, you confidently give yourself a raise. You take the trip. You buy the car. But if the market is crashing, you temporarily tighten your belt. You cut out a luxury expense for 12 months to protect the core machine, allowing it to survive the sequence risk and power your life for decades to come.
The financial system was never built to tell you this. The industry makes trillions of dollars funneling your hard-earned wealth into passive, declining risk funds that quietly expose you to the ravages of sequence risk and the compounding nightmare of healthcare inflation. They profit immensely off your illusion of safety. But now, you see the structure for what it truly is. You understand the undeniable math behind the rising equity glide path. You see the historical anomalies hiding in small-cap valuations, and you possess the exact blueprint to unlock the 4.7% withdrawal rate. So look at your own portfolio. Look at your statements. Ask yourself the uncomfortable question. Is your wealth trapped in outdated rules designed for a bygone era, or are you structurally positioned to survive the new reality? Think about it, because the ultimate choice is entirely yours, and the consequences will fall entirely on you. Thank you for joining us for this explainer on USA Rift. If this changed the way you view your money and your future, subscribe to the channel, like the video, and comment down below on what you thought. And again, if you want to help us keep exposing the truth, support the channel by becoming a channel member. Until next time, stay focused and keep looking beneath the surface.